Good evening. You're with us here on The Money Show. I'm Amarpal Chadha, and we are here to really dissect and simplify all those financial queries that you have with our experts. Amarpal Chadha joining us today, Partner People Advisory Services at Ernst Young. Amarpal, thanks so much for joining us. You know, today we're really talking about taxation and also how it comes into purview when we're discussing people who have earned abroad and are taxed in both countries. This is something that, you know, we get a lot of queries on, and we thought we'd take a closer look at it today and sort of talk about what some of the options are, you know, what the norms are when it comes to income earned abroad as well for Indians. So let's just take that away and start off with that and get a sense of really what's at play there.
Sure, Abba. So, very simply put, if you look at any income that is earned outside India, the general perception is that if a person is working outside India and the services are rendered outside India or a business is run outside India, the general perception is that the income that is earned is only taxable in the foreign country and not in India. I think it's very important to understand that if a person is resident in India, they continue to be taxable on their global income in India. So irrespective of the fact if somebody has actually been in employment or rendering services outside India, if they end up qualifying as a resident in India, they would be taxable in India. There are many circumstances which are reverse scenarios. So let's say an Indian resident going outside to work but continuing to have investments in India, a house in India, a saving bank account in India. People earn income in India, but they realize that no, they are no longer working in India, but they're sitting outside in another country, so the income that they earn in India may not be taxable in India. Both these scenarios create a lot of complexity around taxation for such individuals. So in principle, if there is any income that is arising in India, that is either due to a property being in India or an investment being in India, that income continues to be taxable in India irrespective of the residential status. Whereas if any income is earned outside India and you qualify as a resident, the income still becomes taxable in India. So these are the basic principles which need to be kept in mind to have a basic level understanding of how tax works.
Okay, so let's talk about deductions and exemptions as well for NRIs. What would be, you know, what would fall under those brackets? How can they avail of them?
Sure. So since the income is taxable in India, most of the deductions available under the Act are also applicable to residents as well as non-residents. There are mostly all the deduction, for example, an ATC deduction, which we all properly understand as 1,50,000 rupees plus a 50,000 rupees for the investment in pension and others. All of them continue to be available. Even the deduction for a medical benefit, they are also available. So most of the deductions, for example, a deduction from housing, for a standard deduction from housing, or a deduction for interest earned from a saving bank, all those continue to be available even to a person who is not resident in India. Since their income is taxable in India, they're also eligible for those deductions.
Okay, in fact, you know, just to take that forward as well, Amarpal, we had Mubina go through, you know, some of those categories as you also just outlined and just put it together for us. Mubina, if you could run us through those deductions as well.
As an NRI, yes, I do not have to pay taxes on income that I earn abroad, but the salaries and the house property that I do earn in India is very much taxable. Of course, the question also arises as to who is an NRI. Well, if you have spent less than 182 days in India, you do qualify as an NRI. But hey, everything's not hunky-dory because there are certain financial discriminations, if you may call it that, in terms of tax management and tax savings for non-residential Indian. Firstly, all the deductions under Chapter 6A are not available to an NRI. An NRI is not allowed to open a PPF account or hold National Savings Certificate. Not just that, even the medical expenses paid for the treatment of a disabled person or for a specified disease of a family person, or even for that matter, the disability of self or a dependent person will not be allowed to be claimed under Chapter 6A. Additionally, tax deducted as source as well is another big pain point. Usually for regular citizens, you don't really have TDS deducted on short-term or long-term capital gains. But for NRI, there is TDS on short-term capital gains on equities. There's also TDS on long-term capital gains on gold as well as property. Also, ordinarily, the interest that regular citizens earn on, regular bank deposits is subject to 10% TDS, but for NRIs, that is 20%. And NRIs are not allowed to submit the Form 15G or 15H to essentially ensure banks do not deduct TDS. That's really not an option. So these are some of the pitfalls of being an NRI, perhaps, when it comes to tax management of your Indian income.
Thanks for summing that up, Mubina. Now, let's also bring in a query from Mansoori Kesarwani, who says, what is the income tax payable on sale of movable property and immovable property inherited by an NRI who has since become a foreign citizen? Amarpal, would you like to answer that one?
Yes, sure. So as I mentioned earlier, since the property is in India, it really doesn't matter whether the person is a resident or a non-resident. The taxability for a sale of property would either come under the ambit of short-term capital gain or long-term capital gain. In this case, if the person has held it for more than 2 years, it will qualify as a long-term capital asset, and the transaction would be taxable in India. The challenge would be, since the person is not a resident of India, I'm assuming, let's say the person is a foreign citizen or an Indian who's taken a foreign citizenship or is working outside India, is an NRI for India purposes, the buyer of the property would have to deduct TDS. And in order to deduct TDS, you need to know what is the capital gain. The way provisions are worded today, the buyer would end up doing TDS at the rate of, let's say, 20% plus surcharge, which is the maximum rate given the thresholds, would end up doing TDS on the entire amount of sale unless the NRI goes to the tax office through the buyer to obtain a certificate for lower deduction or for quantifying the amount of capital gains. So this process needs to be followed. Otherwise, the only challenge would be that there will be a TDS deduction, and then the NRI would have to file a tax return in India, disclose the sale, and if the person has deducted TDS at the entire consideration, then claim refund from the Indian tax authorities.
All right, so that's the answer to that query. Let's also now talk about, whether or not, Amarpal, there's any way other than, ATC to save tax. What other routes would you possibly take? Yeah, and Abha, this is for everyone, or are you talking specific to non-residents? Let's talk about the non-residents, since that's what we're discussing today.
Okay. So, from a perspective of deductions, I think all the other deductions that are available under the Act continue to be available. So, ATC is one of the deductions that is available. But really, if you plan your investments in a particular manner, whether it's an income from house property, whether it's income from sale of a house property and the proceeds being reinvested under the various sections under which exemptions are available. For example, you could sell a house property and invest in another house property. That benefit continues to be available to a non-resident. You may also have a situation of selling some of the assets other than house property and investing in other bonds that are available, again, which take away the capital gains tax. There is also the provisions for deduction for the house property income that continue to be available. You could take a standard deduction. You could also have repayments of loans from an Indian entity and take those deductions. So under each head of income, the deductions that are available to a resident, barring a very few limited ones which are not allowed, will be available even to a non-resident.
Okay. Amarpal, what about taxation on rent received by an NRI? We receive a lot of queries regarding this as well. And if one were to just simplify the matter once and for all, what are the rules that apply there with regards to rent?
So, again, rent received would go through the normal provision of taxation under income from house property. Even for an NRI, you would get the deductions, which is a standard deduction, 30%, plus any municipal taxes that are being paid or any Indian loans that are being repaid. You get all those deductions. Similar to what we discussed on capital gains, the challenge will come when the tenant needs to remit the rent amount. They will need to again do the TDS route. Will have to deduct TDS at the maximum marginal rate under Section 195 because the person is a non-resident. So you will end up doing a 30% TDS while remitting the payment outside India. So the main problem is the process and the remittance of the money. The taxability really doesn't change.
Let's take a very quick break. We'll also come back and take some queries on the topic that we've been discussing today. So if you're an NRI or if you've been backing some of these issues, we'll discuss those when we come back in just a moment. Well, Times Network and the Association of Mutual Funds in India recently launched Jan Nivesh, an investor education initiative giving people a chance to invest today's income into mutual funds for long-term benefits. You can be part of this story as well. Join the movement and give us a missed call on the number on your screen. Now, P. Kumar is dialing in from Tamil Nadu. He has an interesting question. He's somebody who's actually returned back to India a while ago, Amarpal, but he has some views on the current taxation structure. Mr. Kumar, just run us through your question once again, please.
Yeah. See, what I was asking, I came back long in 2009, I came back and settled. Now, my only question is to Mr. Chadha that what is the total taxation mix of the stamp duty and the property tax? Because a lot of the capital which was earlier inbound coming to India is now of late going to Dubai and, Burj Khalifa and all. So it is a great loss. Like even you see Malad and your Kandivali, all our Gujarati people who were having a lot of kind of properties, they are selling the property and going back to. I was just trying to understand what is the kind of a mix, because real estate is something which attracts maximum employment. Why we are facing this no job creation, no job growth? Because the real estate, which is after agriculture, is the highest, producing the jobs and other things. Furnishings, white goods, everything is going to be driven through the real estate drop.
So I think,
so just I wanted to,
yeah. So I think what Mr. Kumar is trying to ask here, Amarpal, is just whether the taxation structure is not conducive to NRIs coming back and investing in property here.
Yeah, sure, Abha. I'll take that. So, I think thank you, Mr. Kumar, for the question, and I would be really happy if I had answer to all your questions. Very good points that you are raising. We do see investments happening a lot in India too. So, I think it's also the fact that the investors want to diversify their holdings. So you would see, and as you rightly pointed out, investments in Dubai, other countries. But at the same time, if you see the real estate expansion in India also, there's lots happening across different cities, whether it's Bangalore, it's Mumbai. But I take your point, there are definitely stamp duty, there are charges on the guidance value in many locations that's creating some level of confusion. We had in one of the last shows a person saying that the guidance value actually is much, much higher than the market price, creating a very high level of stamp duty to be paid to the government, whereas the actual price is lower than the guidance value. So definitely some of these ambiguities create a negative reaction in the investor community. But I think that's also true in only some pockets. Mostly we've seen trends of guidance value being lower than the market price. But yes, there is an incidence of stamp duty, there is an incidence of property taxes that you need to pay, and it does vary. So if you look at even the fact on transfer of a property, a capital gains taxation in long term is only 20%. So if you hold the property only for 2 years, the tax comes down to 20%. Plus, you also have investment avenues to even mitigate that tax amount. You could sell a property, invest in another property. For an individual even to own a commercial property, the same treatment as a house property is given. So you could get benefit of the deductions that are available also for a commercial property. So in a way, the Income Tax Act does enable. And if you see one of the recent amendments in the 1920 budget that has come, you are now allowed to sell one and buy two properties, so that you could actually split your holding into two properties and still be eligible for an exemption under 54. So there are some pockets of provisions available which are facilitating or attracting more people towards the sector, but some inherent problems do remain. I hope I have given you a very circular answer to your question.
Yeah, I think that sums it up, Amarpal, quite in quite a lot of detail, in fact. Thank you for that. Now, we've got Jyoti Acharya writing in, wanting to know how much TDS would be deducted for a flat which is to be purchased from an NRI. The said NRI does have a PAN card number, and the flat was transferred to her name on a share certificate of the society in 2012. So what kind of TDS would be deducted on it?
Okay, good question. So 2012, that means long-term capital gains because the transfer is happening now. Only challenge, the person is a non-resident, the seller is a non-resident, so when the buyer makes the payment, he will have to deduct TDS. If the seller is able to provide a certificate with the help of the buyer from the income tax department, the deduction can be limited only to the capital gains. So 20% or 23% of the capital gains can be deducted and deposited by the buyer with the Indian tax authorities at TDS, and the balance amount can be remitted to the seller. In case the seller and buyer don't agree to get this certificate, then the entire TDS would be on the sale consideration, not on the capital gains amount. Also, a point to note, maybe not for the seller, but for the buyer, it's very important to remember that the liability to withhold TDS, tax deducted at source, continues to lie with the buyer. So in an arrangement where the buyer does not do TDS, the Indian tax authorities are empowered to go after the buyer of the property, even later on, to make good the TDS that the buyer didn't deduct. So not the seller, really the buyer needs to be very cautious in transactions with the NRI.
All right, we have one more query coming in from Piyush, who's 30 and moved to the US 3 years ago for work. He says he saved his wealth in savings accounts and FDs in India. He's also bought an apartment and given it on rent for about 30,000 a month. Every month he transfers 40,000 to his parents for household expenses and their insurance policies. So given the incoming and outgoing, will he still be taxed?
Yeah. So unfortunately, don't have a good answer for you. Even if you have income in India through your fixed deposit, as well as you have an apartment that you mentioned, so even if you get rent from that, that will be taxable in India. The amount you extend to your parents for household expenses is not a deductible expense, neither for the insurance. So all those expenses continue to be non-deductible. The entire income that you earn from fixed deposit as well as rental will be taxable in your hands. Both are income sourced in India, so your residential status really won't make a difference. You will still have to file a return and disclose this income in India.
All right, Amarpal, thanks so much. I think this was incredibly helpful for so many of those that are trying to manage their investments and taxes as they move back and forth. Thanks so much for joining us on the show today, and that's all from us on The Money Show. Thanks so much for watching. We'll be back with more tomorrow, same time.